Hello everyone and welcome to this training video on NFR D Financial Reporting. In this session we are going to go through some of the key details you will need to know from NFR D Financial Reporting. We will be discussing at a high level the key parts of NFR D which you need to be aware of. Just to flag from the start, it's not possible to cover off everything in detail, so all staff are required to be familiar with the document. With that in mind, we would recommend the staff read the document themselves to ensure that they are fully briefed on their day-to-day requirements. There are additional handoff documents that are also useful to be familiar with, and in particular the AFS Standard Operating Procedure with regard to financial reporting. The topics we are going to briefly look at today include the Annual Financial Statement, known as the AFS, its timelines, the accounting standards the HSE apply, and some of the specific AFS accounting policies and standards, such as income and deferred income, leases, property, plant and equipment known as PPE, and depreciation, inventory including stock valuation and stock taking, financial sanctions including write-off of bad debts and stock and special payments, and finally journals, accruals and provisions. So let's get started. Firstly, what are the National Financial Regulations? So they are a set of policy documents which sets out financial controls for an organisation. They are not meant to be detailed procedural documents for financial processes or activities, as they are contained within your local procedures. But the aim of the NFRs is to provide high-level controls to guide your local procedures. Secondly, why is this particular training important? It's important that you are aware of the controls and guidance that you must follow when you are involved with preparing accounts, financial reporting, and in particular the AFS compilation. Moving on to an important question which discusses who is the actual target audience for the NFRs. In short, the NFRs have a very broad reach. They apply to all permanent, temporary and agency staff of all HSE divisions, CHOs, hospital groups, where services are provided on behalf of the HSE, and also Section 38 and 39 providers, where services are being provided on behalf of the HSE, or where HSE grant aid funding is being received. Moving on to the purpose of the NFRD. So NFRD sets out controls for financial reporting with a particular focus on the HSE's annual financial statement. It sets out the accounting policies used in the preparation of the HSE's AFS. It provides staff with guidance on procedures relating to property, plant and equipment, inventory management and stock taking, financial sanctions and write-off of bad debts and stock, and journal, accruals and provisions. The HSE prepares the AFS under Section 36 of the Health Act 2004. This includes the primary financial statements and notes to the accounts. The AFS must be completed on or before the 1st of April in the next year after the current financial year has ended. For example, the AFS for the financial year ending the 31st of December 2022 will be completed on or before April the 1st, 2023, with the AFS required to be signed off and the associated audit certificate issued in May 2023. The process spans over 8 months, with preliminary work starting in October and November, with reconciliations taking place to Q3 of the current year for interagency accounts and non-Department of Health income sources. The AFS preparation workshop takes place in November, and AFS templates are circulated by the AFS team in December for completion at year-end. In January, the year-end accounts are compiled by each area and the AFS templates completed. Interagency and non-Department of Health income are reconciled to year-end and submitted to the AFS team. In February, each area then submits their completed AFS template electronically to the AFS team for consolidation. This includes capital commitment details and income figures confirmed at year-end by Treasury and Capital. The first draft of the consolidated AFS, including the notes to the accounts, must be completed and forwarded to the Department of Health and the Office of the Controller and Auditor General, CNAG, by the end of February. In March, the consolidated AFS is considered by the HSE Audit and Risk Committee, the ARC, which includes the Statement of Internal Controls and the Operating and Financial Review. In addition, the draft AFS is submitted and signed off by the HSE Board at the end of March. The final AFS is adopted by the HSE Board by the end of April, with inclusion of the AFS in the annual report for adoption by the HSE Board. While all of the aforementioned is happening, the CNAG are performing their external audit on the year-end accounts, which culminates in May when the final AFS is signed. This, however, can change depending on if the CNAG require any amendments. Audit certificate is issued by CNAG before presenting the HSE annual report to the House of the Oireachtas by the Minister for Health in May. The AFS are prepared on an accruals basis in accordance with the Historical Cost Convention. Accruals basis is the method of recording accounting transactions for revenue when earned and expenses when incurred. Under Section 36(3) of the Health Act 2004, the Minister for Health specifies the accounting standards to be followed by the HSE. General Accepted Accounting Principles, probably more recognised by its acronym GAAP FRS 102, in accordance with accounting standards issued by the Financial Reporting Council, is the accounting standard adopted by the HSE, with some exceptions which have been specified by the Minister for Health. Depreciation. Under GAAP, depreciation is formally charged to the Statement of Revenue, Income and Expenditure, but HSE depreciation is charged against the Capitalisation Reserve account balance. Capital grants. Under GAAP, capital grants received from the state to fund and purchase of property, plant and equipment are recorded as deferred income and amortised over the useful life of the PPE. In the HSE, such grants are accounted for in the Statement of Capital Income and Expenditure as incurred. Capital grants and capital expenditure in relation to assets other than those purchased by way of service concession arrangements are recognised in the Statement of Capital Income and Expenditure as incurred. Under FRS 102, such expenditure is capital charged to income and expenditure over the life of the asset. Some minor capital expenditure can also be funded from revenue. In this case, the amount is charged to the Statement of Revenue, Income and Expenditure in the year. This accounting treatment, which does not apply with GAAP, is an exception specified by the Minister. Pension. Pensions are accounted for on a pay-as-you-go basis. The provision of FRS 102, Section 28, employee benefits are not applied. The liability for the future pension benefit accrued in the year has not been recognised in the financial statements. Clinical indemnity. Claims under the Clinical Indemnity Scheme, which are paid for by the HSE and administered by the State Claims Agency on the HSE's behalf, are accounted for on a pay-as-you-go basis. Details of the amount recognised in the Statement of Revenue, Income and Expenditure, together with the actuarially estimated future liability attaching to the scheme, are set out in the AFS SOP policies and procedures. The HSE Governance Act 2013 states that the following structure is to be applied when completing the annual financial statement templates: the acute hospitals, including the ambulance service; primary care, including palliative care; mental health; disabilities and older persons, which are representative of the service areas in the community health organisations; and finally, health and well-being and corporate support services. There are a number of AFS accounting policies and standards addressed in NFR D and the AFS Standard Operating Procedure, but we are only going to discuss a few of the main ones here. We would advise that you read the entire Financial Reporting NFR to be familiar with all the additional content and how it applies to your role. As previously mentioned, we will address income recognition and deferred income, leases, property, plant and equipment, inventory and stock policy and stock takes, finance sanctions and their application in the write-off process, write-off of bad debts and stock, and finally journals, accruals and provisions, which are a key part of the accounting process. So let's move on to the first topic, income and deferred income. The Department of Health provides grants to the HSE for administration, capital and non-capital services. As grant income is recognised on an accruals basis, the amount specified in the letter of determination for the relevant financial year is recognised as income in that year. Grant income for administrative and non-capital services is accounted for in the statement of revenue, income and expenditure. Where non-capital grant money is used to fund capital expenditure or grant income from capital services, it is accounted for in the statement of capital income and expenditure. In respect of other income, patient and service income is recognised at the time of service is provided. Superannuation or pension contributions from staff are recognised when the deduction is made. Income from all other sources is recognised when received, except for payments made for products and services that are to be delivered in the future or where the expenditure has not yet occurred. Deferred income then. As a rule, the Department of Health's income should not be deferred. However, there are additional projects where exceptions may apply when specified by the Department of Health. Service level agreements for each project should be reviewed for more details. Deferred income account is reserved for unspent donations and the bequest to the HSE where donors have specified the purpose of use. Monies held by law agents in respect of prospective sale of HSE-owned property. Purchase deposits where the title has not yet been transferred. Unspent general practitioner development money. This relates to the Northwest only, as they are the only areas to receive GP's development money in advance. There are 4 types of leases accounted for in the HSE: operating and financial leases, and leases under the public-private partnership, and finally service concession agreements. Operating leases are dealt with in the financial statements as they fall due. Finance leases may involve an element of borrowing. The HSE is not allowed to enter into any financial agreement without the sanction of the Minister of Finance, in accordance with Circular Number 1, 2021, Code of Secured Borrowing by General Governments. Finance leases from predecessor bodies, where assets have been acquired under finance lease. These leases have been taken over by the HSE when it was established. For these leases, the capital element of the asset is included in fixed asset and depreciated over the useful economic life. Primary care centres acquired under public-private partnership service concession agreements are capitalised and accounted for using the lease liability model. Assets acquired under service concession agreements are handed back to the HSE at the end of the concession term, with the useful economic life to that of the asset when originally commissioned. No depreciation applies on these assets. Property, plant and equipment comprises of land, buildings, work in progress, equipment and motor vehicles. For the purpose of this session, we are going to refer to them as equipment. As required by the Minister, expenditure on property, plant and equipment additions is charged to the Statement of Revenue, Income and Expenditure, or the Statement of Capital Income and Expenditure, depending on whether the asset is acquired through capital or revenue funding. Both capital funded and revenue funded assets can be capitalised in certain cases. Capital funded assets and revenue funded assets are capitalised if the cost exceeds €10,000. Assets that do not exceed €10,000 do not need to be recorded on the fixed asset register. Where equipment greater than €10,000 is purchased from capital, the equipment is capitalised. When less than €10,000, they are included in the annual financial statement note, capital expenditure, under expenditure on HSE projects not resulting in PPE additions. A breakdown of asset additions by funding source is provided and is also included in the notes to the accounts. When equipment greater than €10,000 is purchased from revenue, the equipment is capitalised. When less than €10,000, the equipment is written off or expensed in the year of purchase. Local HSE areas need to log all assets where asset value does not exceed €10,000. This includes assets such as laptops, mobile phones, and other items that are in use for more than 1 year. Depreciation is calculated to write off the original cost or valuation of each asset over its useful economic life on a straight line basis at the following rates. Land and work in progress are not depreciated. Building is depreciated at 2.5% per annum, so over 40 years. Modular buildings depreciated at 10% per annum, so over 10 years. Equipment to include computers and other equipment. Computers, depreciated rate of 33.33%, so over 3 years. And other equipment, an annual 10%, so over 10 years. Motor vehicles are depreciated at 20%, so over 5 years. As mentioned earlier, one of the exceptions under GAAP FRS 102 for the HSE is that depreciation is charged to the statement of financial position reserve account called capitalisation accounts over the useful economic life of the asset rather than the statement of income and expenditure. Fixed assets which are subject to depreciation are depreciated for a full year in the year of acquisition. For more details on PPE acquisitions and disposals, please see NFR B7, Property, Plant and Equipment, and read the NFR D in full for disposal accounting treatment. Let's now move on to inventory. Inventories are valued at a lower of cost and net realisable value, NRV, considering deterioration, obsolescence or change in demand. At year end, the only method to be followed is valuing the stock at the lower of cost or net realisable value as per FRS 102. When it comes to vaccine inventory, the HSE historically carry a provision against specific vaccine inventories. Any write-off or adjustment for obsolescence are charged in the current year against revenue, income and expenditure. Now I want to discuss inventory policy. It should be noted that when we speak about inventory here, it does not include fixed assets, which are discussed in NFR B7, Property and Equipment. Inventory should only be held where it is not practical to purchase goods on an as needed or just in time basis. Excessive inventory should not be held as it ties up cash flow, increases the risk of inventory becoming obsolete and results in higher storage and insurance costs. Budget holders are responsible for establishing arrangements for the care and control of any stock or stores of materials held in their area. Each store must be effectively and efficiently managed to ensure that stock lists are accurate and up to date, indicating stock levels and price. High demand items are available with minimal delay and at a competitive price. Appropriate data is available for all stock items. Stock items are maintained at optimum levels. Material and stored safely and securely. Stock, and in particular reserved and restricted items, are available to approved users only. Timely and accurate information is available on store transactions. All employees are responsible for the prudent use, care and safeguarding and HSE stock in their possession. Obsolete inventory is inventory that is no longer of use to the HSE. Stock items without demand for a sustained period. Slow-moving stock refers to items that have not been used for a specific number of days, weeks or even months, etc., or which have a low usage rate. Obsolete stock costs money in storage and initial outlay, so should be kept to a minimum. If you manage goods, you must examine those materials that are slow-moving on a regular basis, and at a minimum twice yearly. You should consider, firstly, identify, are the items obsolete, slow-moving or out of date? Can the items be returned to the supplier? Also consider here the dates, the current value and the restocking or returning costs involved. Could the item be used again in the future? Can some surplus be returned to the supplier? Similar to the previous point, take account of dates, values and costs. Would another department have use for the item? Could it be transferred to another area of the HSE? Could the items be resold to recoup some of the value? If this is an option, you may need to follow the disposal guidance for assets in NFR B7, Property and Equipment. If there is no further use by your department or other departments within the HSE, and no value can be recouped, then you may consider donating the item to a charitable organisation. If write-off is considered, be mindful that an individual write-off which exceeds $30,000 requires approval by the Chief Financial Officer of a hospital group or Head of Service or Head of Finance of a CHO or designated approver. A year-end stocktake must be carried out in all areas where significant stocks are held. Physical inventory is valued at the end of the accounting period to ensure inventory costs are recorded accurately in the annual financial statement and to form an accurate inventory opening balance for the coming year. One manager in each stock location should be assigned responsibility for the stocktake and should follow the guidance provided in NFR D in Section 3. Responsibilities include organising staff for the count. Stock takes can be conducted by appropriately trained HSE staff or qualified external parties. Creating the master schedules, timing, communication, purchasing supplies, preparing the stock area and providing instructions for the stock count. Finance must be informed, who then issue advance notification of a minimum of 2 weeks to independent observers, C&AG or internal audit. The physical count process is outlined in the NFR and should be followed when planning and performing the count. Cycle counting. Count stocks at regular intervals allows fast-moving items to be counted more frequently than slow-moving items. It allows you to group inventory into categories based on consumption, value or other relevant criteria, and to count certain stocks more frequently without constantly adding up the entire inventory. Essential or expensive items should be counted more often to ensure appropriate supply is on hand. If the accuracy of the cycle counting can be maintained at a significantly high level, the need for an end-of-year stocktake may be eliminated or reduced. Agreement should be reached with the local manager prior to implementing cycle counting. The stock valuation methods applied in the HSE. Stock is valued only by either first in, first out, weighted average or some similar method such as standard cost. Maximum and minimum stock threshold levels should be reviewed at 6 monthly intervals to ensure their accuracy. Any necessary changes should be made to ensure compliance with the stock holding policy of the HSE and to ensure optimum stocks are available. At year end, in accordance with FRS 102, the only method to follow is the lower of cost of net realisable value, NRV. Financial sanctions. The HSE must comply with specific requirements of the Department of Health in relation to obtaining sanctions to incur expenditure in relation to write-offs, losses, legal awards and settlements. For example, claims that are not covered by the State Claims Agency or HSE insurance policies. The HSE is required to comply with the Public Financial Procedures (PFP), and any finance sanctions must be given the appropriate approval by the Department of Health. The HSE must ensure that all reasonable efforts have been made to recover the losses or debts, and that there are effective systems and controls to limit any future losses of a similar kind. Any loss or write-off in excess of $30,000 must be approved by the Chief Financial Officer, hospital groups, or Head of Service or Function, or CHO Head of Finance, as well as the Department of Health through finance sanction. Your Regional General Manager Financial Specialist should be notified of all debts written off in excess of $30,000 in order to complete the annual financial statement reporting and sanction process requirements, and for onward notification to the Assistant Chief Financial Officer Financial Specialist. Legal awards and settlements in excess of $50,000 or court awards against the HSE which have a wider public interest must receive prior specific approval of the Department of Health. For more information on legal awards and settlements, please see Section 6.2 of the NFR. Write-off of bad debts and stock. A provision is made for amounts due which are considered doubtful to be repaid. For example, a provision is made for patient debt which are outstanding for more than 1 year, and payroll overpayments are fully provided. Before bad debts are written off, it is important that the local HSE area tries to recover the debt. For details of the HSE bad debt provision policy and debt process, see Section 214, Bad Debts in this NFR. For more information on debt collection process, see NFR B2, Income Charges and Debtors. The Department of Health delegates authority to the HSE to write off losses within specific requirements and limits. According to the Public Finance Procedures, losses include physical cash losses, stores losses, claims waived or abandoned, and fruitless payments. Due to the time frame involved and the completion of the annual financial statement, the proposed accounting treatment for bad debts stock write-off is on the basis that they are written off in the AFS throughout the financial year, subject to seeking DOH sanction at year-end. Sanction is requested on a once-yearly basis following year-end. Individual write-offs under $30,000 for patient bad debts, stock and other bad debts can be dealt with utilising the delegated sanction, which is a yearly letter of sanction from the Department of Health, once the specific requirements are met. Individual write-offs over $30,000 for patient bad debts, stock and other bad debts, application for sanction is required. There are AFS templates to be completed annually for sanction of write-off and losses. The templates are categorised by debt type. Write-offs must be approved locally by the Chief Financial Officer of a hospital group or Head of Service or Head of Function of a CHO or a designated approver. Then, the General Manager, Financial Specialist in your region should be notified in order to complete the AFS requirements for onward notification to Assistant Chief Financial Officer, Financial Specialist. For more information on delegated authority and finance sanctions process, please see Section 6 of the NFR. In addition to write-offs of losses and debts, finance sanctions can also be requested through the Department of Health for special payments on a yearly basis following year-end. Payments such as gratuities, performance-related awards, payments to retired employees, severance awards, ex gratia payments, and labour court or adjudication officer awards. Any payment of this nature, similarly, needs to be forwarded to the General Manager, Finance Specialist in your region as part of the AFS year-end process, similar to the write-off process discussed in the last slide. The HSE currently has a high volume of manual journals, and the authorisation of these can cause problems with non-compliance. HSE staff must be aware of the policies regarding the audit file when posting journals. Sufficient and accurate evidence of all transactions must be documented and maintained in an appropriate manner. This ensures the audit trail is maintained on all income and expenses, including the purpose of the income or expense and the reasoning behind this journal entry. Accruals must also be prepared consistently throughout the HSE in a manner that exercises appropriate discretion and judgment. Each accrual must provide supporting evidence for why it is required. Accrued expenses and provisions require documenting for audit purposes, meaning adequate support. Accrual templates should be completed, appropriately approved by 2 signatories, and with supporting documentation attached. If the backup is a soft copy file, a summary sheet should be added with description of the backup, reference to the location of the backup, and the name of the accrual contact and email address. Each posting must have appropriate approval. Support and approval must be in place prior to posting. And proof of payment must be added to the back of the accrued document when payment has been made. Provisions should be reviewed at each statement of financial position date and adjusted to reflect the current best estimate. If a provision is being reversed, the reversal must be classified the same as the original provision within the statement of profit and loss. For further details, please review the HSE's Journal Entry and Balance Sheet Reconciliation Policy available in the NFR. So that brings me to the end of the training session on NFR D Financial Reporting. On this slide is the contact details of the Governance and Compliance team. If you have any questions, you can contact us on govn.compliance@hse.ie. Also on this slide, we have some useful training resources and our Governance and Compliance YouTube channel, and that contains videos on each of the 11 individual NFRs. Most of these are just 10 to 15 minutes long, so they are a good resource if you want to refresh on any of the NFRs. Your attendance and attention today is very much appreciated, and thank you for taking the time to watch this training session.